All right, today's video is going to be a little bit different. Today we're digging into what famous TV personality Jim Cramer recently said about buying stocks right now. We're also going to dig into one of the most recent picks to see if it actually holds up, and we're also breaking down a stock that our community rated as one of their top stocks. So let's first off start with Jim Cramer. He says investors should not be buying stocks at all-time highs right now. In fact, he called buying stocks near their all-time highs a license to lose money. That sounds incredibly smart. It sounds cautious. And you might sit there and say, well, Paul, don't you say the same thing? I do not. What I say is, don't buy individual stocks at egregious valuations. And it's the kind of advice that has cost everyday investors millions of dollars over time. Now, before anyone gets defensive, let me be very clear. This video isn't just about attacking Jim Cramer. I will continue to do that. But he reacts to market movement every day. That is his job at CNBC. He looks at volatility. He claims to look at earnings. He looks at stocks that are up, down, huge for the year, and he tries to make predictions. Guys, remember, Jim Cramer is not an investor. He is a trader. If you look at his history, he had a hedge fund where he traded stocks. He did not decide what stocks were undervalued based on fundamentals or anything like that. He looked at movement and momentum. And honestly, some of what he's saying is not wrong. Buying blindly at all-time highs can be dangerous. Chasing hype can lead to losses. But here's where investors get into trouble. Market commentary is designed to help you feel safe today, to make you want to keep watching. Investing, on the other hand, is about making good decisions for years and decades to come. Those are very different things, and they have very different goals. Now let's look at what Jim Cramer actually said. Cramer's core warning was simple. After a strong market rally, buying stocks near their highs can be a license to lose money. He pointed out that many stocks were up 30 or 40% year to date last year, and he urged investors to become more selective instead of chasing what's already run. Guys, on the surface, that sounds completely reasonable and something I would agree with. It actually sounds like he's found some common sense. He's also highlighted specific near-term risks. He cautioned that oil stocks could face pressure if supply increases, and he warned that banks could struggle as earnings releases start to come out. Now, something important I want to point out very clearly. Jim Cramer is focused on the short term. Most pundits on TV, in fact, I'd say all of them, are focused on the short term, reacting to what just happened and trying to extrapolate that out when they claim for the long run, but it really isn't. That is not investing. That is speculating about stock price movements. That's trading. Now, I know people who are amazing traders because they have really strong process. Take Mo, for example. But I'm not sure Jim Cramer fits the criteria for investing. But let's move on from right now. So now, if you're wondering the same thing as most people, you're asking, how have Cramer's picks performed so far? Guys, there is a very popular Twitter account called Reverse Cramer. There was actually an ETF made called the Reverse Cramer ETF. For those who don't know, we can actually measure what happens when investors follow Jim Cramer's recommendations and when they do the opposite. So instead of just debating opinions, let's look at the data. A firm called Quiver Quantitative tracks Jim Cramer's stock recommendations and measures how those stocks perform after his calls. Over time, a portfolio designed to do the opposite of Jim Cramer's recommendations has greatly outperformed the portfolio that follows them. That's what originally sparked that inverse Cramer ETF. Its strategy was simple. Just go against short-term TV recommendations that are driven by recent price movement, volatility, and headlines. I'm sure you guys have already heard about people tracking Nancy Pelosi's trade. Well, according to an article by Benzinga, picking the opposite of what Cramer says would have returned you 60% in 2025. The Pelosi tracker returned 25%. Now, guys, I can't stand Nancy Pelosi's politics. She is an absolute hypocritical piece of shit. I absolutely can't stand her. But you've got to remember, when we see Nancy Pelosi's trades, those are delayed 45 days or more because she reports them, but they don't have to get released for quite some time. So it's almost impossible to actually follow her trades because you're going to be 45 days removed. With Cramer, he's on TV and on the internet saying these things, and we can track them immediately. So Let's check out a stock that he actually recommended just a few short days ago. Home Depot. Guys, Home Depot is one of the highest quality retail businesses in the world. It dominates home improvement, it has huge scale, and it has a business model that generates consistent cash flow and is probably primed for increasing that cash flow for years to come. There is no doubt in my mind that I would love to own a company like this. In fact, it is on my list of 30 companies that I would like to own forever. They basically have a duopoly with Lowe's, and they hold a whopping 47% market share compared to Lowe's at 28%. But there's more to it than that. There's a big difference between a great company and a great investment. What's the difference? The price you pay. So let's see if Jim Cramer's pick of Home Depot stands up to the test of what I perceive to be value investing.
That's why we own Home Depot. I think it's a better way to own it. And Home Depot has historically went up ahead of when the Fed cuts. So I like in that one more than I would like to be in Fortune Brands.
So guys, that video you just saw of what Cramer said, he's doing the same thing Bitcoin people said. He's attaching himself to a story. What I would sit there and say to him is, okay, Jim, great. This company does well against lowering interest rates. Okay, well, let's go check out the chart here real quick. So guys, when he says it does well when interest rates go lower, and that would tell me it does poorly when interest rates go higher. This is where interest rates were, 293 back in, that's when rates started to go higher, and we're now at 375. Okay, we talk about 2000. I'm gonna get to that a little bit later, but look at Home Depot. This is a chart from January of 2000 to January of 2010. The interest rate back here by the Fed was 5.5%. 2010, it was 0 to 0.25%. He said this company does better when interest rates are going down. Interest rates went down 95% and the stock went lower. I don't think this tells me that the company does better when rates are going up. What it tells me is overvaluation. He doesn't even mention valuation. If you listen to Jim Cramer about investing, you are going to end up learning the wrong things. This isn't just a 1 month proof. This is 10 years of proof. Rates just went like this over that 10 years. But what happened? Valuation's bad, you end up losing out. Now you might sit there and say, yeah, but Paul, $70 and now it's at 380. Do you know what kind of return that is? Let me show you. That's 25 years ago. So we're at 375 divided by 70 to the 0.04%. That is 7% plus a dividend yield. So it has done pretty decent since then. But look at it from here, $30. Would you have actually stuck it out all this way, seeing it go from 70 to 30 over a 10-year period? Under 30, by the way. That's a tough task. It's short-term comments he's making. It makes no sense. Is Home Depot a great company? Yes. Are they going to do well? You know, I just look at everything and say, fine, all those things you said are true, even if you add 2 zeros to the stock price. It's all the same thing. If your thesis isn't changing when the stock price changes, then you're not an investor, you're a speculator. That's my criticism of Bitcoin. It's my criticism of so many things out there. You can still speculate into income-generating assets. It's about your process. What process are you using? But if you don't have an income-generating asset, it's even harder to be a fundamental investor and a value investor. Here, he is mixing speculation with investing because everything he said is true whether you add 2 zeros to the stock price or take 2 away. That's not investing. So guys, Home Depot, incredible business, $375 billion market cap if you want to buy all the shares outstanding at the current price. It's got a decent dividend of 2.4%. A lot of dividend people love that. And it eats up $9 billion of their $14 billion in free cash flow last year. All right, margins are pretty consistent in the 9-10% range, a little bit lower last year, a little bit higher in the last 5 years. Not much growth rate, 1.85% a year for the last 3 years, but 5.76 in the last 5 and 6.7 a year for the last 10. All right, so a lot of good stuff here to know. 27 times price to free cash flow, 25 times earnings. All right, some things to look at. Let's look at their 8 pillars here. Let's see what the story it's telling us is. Okay, cash flow is down considerably in the last 5 years, even though net income is up. I wonder why that is. Let's go check it out. Oh, was that COVID year when everybody was just like renovating their houses? That might have been why. Let's go check it out. Let's go to the cash flow statement. Yeah, big 16.38. All right, big jump the COVID year, which makes sense. Their big jump. Remember when everybody was staying home from COVID and just like, oh, I might as well do this renovation I've talked about doing. And then the rest of it's good. Look at this return on capital, 38% over the last 5 years. What does that mean? It means this company is very efficient with their cash. It means they're able to take the money that they have and reinvest it at good rates of return. If there aren't opportunities for that reinvestment because they're so big, like Home Depot, it shows that this is kind of like a moat status business. That's how to find out how big the moat is. One way to look at it is returns on capital. Everything else, pretty solid. I'm not worried about debt. Even though debt's a check mark, it's a retail place. They're going to have a lot of debt. Now, guys, this might feel overwhelming. It's okay. Everybody in the history of the world has been overwhelmed. Nobody woke up and said, I'm really good at investing. I understand these things. Even Warren Buffett. I'm here to simplify all this for you. And I have a great cheat sheet for you to download that will explain all of these key metrics for you. That way, when you're ready to look at a company, you can pull it right up and follow along in the videos and on your own when you're looking at company metrics. And of course, isn't it nice just to sound smarter than all your friends? So they're all talking about companies. You can sit there and say, I just don't like their returns on capital. They're kind of bad. Or, hey, this is a really good business. Look at their returns on capital. They're really efficient at making financial decisions. So click the link below, download the PDF. I assure you, if you're able to understand these PDFs, you will be better than 99% of people out there on investing. And that's why I'm here to teach on YouTube. Because investing is about being a genius. It's about understanding numbers, but having the stomach to be able to withstand the bad times. Okay, analyst estimates. Guys, look at this growth. Nothing to write home about, but pretty decent. $15.50 per share earnings this year, growing to 21 in the next 4 years. And then revenue growth, boilerplate, 3.5, 4.5, 4.5, 4.5, 3. This is not a grower. That's why you got to pay a reasonable price for this, especially because you're not going to get that massive growth in revenue that's going to absolutely skyrocket earnings and free cash flow. So now we're here to take the story and the numbers and put them together in our stock analyzer tool. This tool allows us to sit here and go, okay, what are my expectations for the future? In this regard, I'm calling it 10 years. Where do I think they'll be? And what price do I need to pay today to get an adequate return on my money? Here are my 10-year assumptions. 2, 3.5, and 5% revenue growth. Profit margin, I did 9.5, 10.5, and 11.5 for both profit margin and free cash flow margin. And the same with PE and price of free cash flow. I did 17, 20, and 23. Now, how did I pick this? Well, I start at the market average of 15 or 16. I go higher for great companies, lower for bad companies. This is a good company. It's got a great moat. It's got high returns on capital. Some might argue this is actually too low of a PE. I could understand that completely. Now, guys, finally, what is my desired return? Well, guys, I like to put in like an intrinsic value 9% return here. Remember, if you're buying individual companies, you've got to put a higher desired return in. That's margin of safety. And if you only want 9 or 10%, just buy a low-cost ETF. It's not worth it to buy individual stocks. So the stock's currently at $375. I hit the analyze button. I have a low price of $240, high price of $448, middle price of $330. Now, before I criticize, I've already criticized Jim Cramer. This could very well be undervalued. We don't know the future. That is the thing that makes investing difficult. He very well could be right. However, if you apply that process of following the story for long enough, you will end up losing out. It'll make you feel like a genius as prices go up. But when times are tough or when prices are normal, which is the vast majority of the time, what are you doing? You're going to end up getting burned. So here I'm applying the same process and I'm looking at going, I don't think you're going to do terrible owning the stock, but at this price, but I don't think I don't think it's worth it in my opinion. That's my opinion. This is exactly where investors go wrong. They confuse price with value. Price is what you see on the screen. It's that ticker going up and down. It moves every millisecond based on headlines, emotions, short-term results. Value is something completely different. Value is what a business is actually worth based on its long-term execution and all the cash flows. Remember rule number 4 of principle-driven investing. The stock market is a voting machine in the short run, but in the long run, it is a weighing machine. Value always matters in the long run. That's why great companies like Home Depot can be terrible investments if you overpay. We saw that exactly happen in the early 2000s. Investors paid a massive premium for Home Depot shares and suffered a lost decade because of it. Value investing is about understanding both quality and value. And guys, the quality matters in determining the value of a business. You're going to be willing to pay a higher price for a better business, one with strong growth, a high return on capital, and manageable debt. But what's most important is making sure that the price you pay today will allow you to achieve your desired return. The more you pay, the less return you make. That is something myself and more importantly, members of our community practice every single day. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money. How to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. Now, here is a company. We've analyzed a recent pick from Jim Cramer. We're going to cover one of the top-rated stocks by our community members, NVO, Novo Nordisk. It is best known for its leadership in diabetes, and a counter effect of that, an externality of that, an accident from that is obesity treatment. Over the last couple of years, this stock has been extremely volatile, falling hard from $140 per share to as low as $43 per share. But I want you guys to remember something very important. For principle-driven investors, volatility can create opportunity. That sell-off wasn't about the business falling apart. It was about expectations resetting over fears that competitor Eli Lilly would permanently take the lead. Over the last week or so, all of a sudden, shares have risen nearly 40% from that bottom. What's changed is that NVO is no longer defending its position. It is innovating again. They are the first to market on their pill version of the weight loss drug Wegovy, which massively outperformed Lilly's in version and trials. They even announced a partnership with Amazon to offer same-day delivery at lower prices. So let's see why our community members are so interested. So guys, we have our community members here rating it as a buy with an average intrinsic value of 81. So that low price, just in November 24 at $43, it is now at $59 per share. It's a $260 billion company that generated $9.5 billion in free cash flow last year. But here's the deal, guys. Net income was 16.2. So a big difference between net income and free cash flow. That could be because of capital expenditures. Let's go check it out and see why that is. That's always a red flag for me when net income is so much higher than free cash flow. Here's one thing. Look at their capital expenditures over the last 7-8 years. $2 billion, $1.75, $3.5, $1.1, $2.3, $6, $8, $10 billion. They've massively increased their capital expenditures. But look at this. Their free cash flow is up big time. Big time. Huge stuff. That's great. Now, let's go back to the key metrics page. Do they pay a dividend? For those of you who love it, they pay a 3% dividend. But here's my question. $8 billion of their $9.5 billion goes to dividends. All right, that's a lot. I know people out there love dividends. They're like, I'm a dividend investor. No, you're not. You're not a dividend investor. You're a highly tax-efficient investor. You sit there and go, how can I make tax-inefficient investments? Oh, I'll pick the company that does the dividends, not the one that's buying back cheap shares. That's my dig at dividend investors. Gross profit, huge, 82%. Makes sense because once you develop the drug, it's just, liquids and pills and powder and all that stuff. So high return on capital, 30 to 40%. Great growth rate. Acquisitions, it's a lot, but it's not a ton. 17 billion over the last 5 years. So it looks like they're growing a lot internally. Let's look at their 8 pillars. Something we'd love to see. The X's are the price of free cash flow and PE ratio. Now remember, guys, we don't know necessarily if these are high. Yes, they're X's, but if this Wegovy pill is huge and they become the leader, the issue I have is that, can they become and stay the leader? It's not a matter of, is it expensive or not? It's a matter of, this could be massively cheap if they're able to double their earnings every year for the next 10 years. This would be massively expensive if their earnings are going to stay flat for the next 10 years. That's the difference there. You're paying for a future stream of income. If that income is going to be way higher than people expect, you're probably going to do pretty well. That's the key about investing, but we don't know that future. So let's go sit here and look at analyst estimates. Actually, not that much. Not that great. 7% earnings per share growth, 7.5, 3, and 11.5. Not as much as I would have thought. And revenue growth, see, this would have surprised me. So they have a high gross margin, which means they make 80% of every extra dollar goes to the bottom line before taxes and overhead. Yet this revenue growth is not massively driving up their profit. That's what confuses me. So I'm actually wondering if I differ than the community on this company. All we have to do here now is we have to sit here and put this all together and put it in our stock analyzer tool. All right, so I did revenue growth of 4, 8, and 12% for the next 10 years. I'm going to knock that down to 3, 6, and 9. No. 4, 7, and 10. Profit margin, I did 30, 33, and 36. Guys, even though I put a lower free cash flow margin in here, I'm still good with this, even though I can see an argument made for why this would be equal over time. Now, what is my PE and price to free cash flow 10 years from now? High returns on capital, but guys, I just think the drug industry is just for me, it's just I feel like drug companies go up and down based on who's leading the market and then copycats and all that stuff, especially with this weight loss drug. Everybody's coming out with their version of it. So I'm sticking with 16, 19, and 22. Still a premium, but not as much as another company like Google or Microsoft or something like that. And then finally, my 9% desired return. The stock's currently at 59. Hit the analyze button. Yeah, this is why people are interested. Low price of 50 to 60, high price of 120 to 130, middle price of 80 to 90. So I don't disagree with the community that it's something to take a look at. So let me leave you with this. When someone on TV says don't buy stocks, the real question isn't whether they're right or wrong. Markets will always feel exciting near highs and terrifying near lows. That's exactly why emotions lead investors to buy late, sell early, and miss opportunities that actually build wealth. If you focus on understanding what you're actually buying and the right price to pay, staying disciplined when emotions are high, the headlines don't really scare you. Because in the long run, guys, the market does reward reaction, but it rewards the correct reaction. It rewards preparation. The more you prepare, the better you will be to react when the time is right, not when everything is overhyped, not cowering into a corner when everything feels scary. Guys, take it from me. I have over 25, 30 years when I started investing, and I felt the same way many of you do. So guys, earlier in 2025, I picked 7 stocks to start the year to go head-to-head with the actual market's Magnificent 7. Click the video on your screen to see which 7 stocks I picked and how they stacked up. The results will surprise you. Thank you for your time.